2023 is going to be an exceptionally important year for the Chinese EV market, in my opinion, as Tesla's recent price cuts have really stirred up a lot more controversy and competition from Xpeng Motors, NIO, and Li Auto in the fastest growing EV market in the entire world. And as a result, there is some uncertainty being developed in the short term around the deliveries year over year for these companies, their profitability, gross margins, and also in some cases their ability to survive what might be a very tough year competitively in 23. And that has certainly been true so far in the January delivery update that we just got from all three companies. Li Auto and other companies like BYD, which are selling plug-in hybrid vehicles, are actually seeing improvements in profitability and deliveries, but the main BEV market from Xpeng Motors, NIO, and obviously even Tesla is struggling. Those vehicles are obviously more attractive to consumers in a recessionary environment when people are more uncertain about investing in an electric-only vehicle, giving range anxiety, charging problems, a lack of infrastructure, and obviously the higher upfront cost. And because Tesla cut prices on their Model 3 and Model Y just a few months ago, there are clear signs that demand is slowing down from an extremely hot 2020, 21, and 22 for battery electric only vehicles. You can see that pretty clearly in the year-over-year delivery updates for all three major publicly listed companies. Li Auto is the only one that saw growth in January of around 23%, with Xpeng seeing the biggest decline of around 60%, followed by NIO of around 12%. Li Auto's three main products, the Li 9, 8, Li 7, and the Li 1, are plug-in hybrid luxury SUVs, which are in a market that is targeted for the upper middle class and the higher classes in China, which are going to be more resilient at a time when savings rates are going at all-time highs and interest rates are about to be cut. When there's so much uncertainty about the economy, people are going to start cutting their purchases on big ticket items. And that unfortunately is going to be hitting the plug-in electric vehicle market probably the hardest compared to the plug-in hybrid. And as you can see, we're already starting to see that in what's happening in deliveries in January. Even if we are seeing a Lunar New Year celebration within the country, BYD, Li Auto are still growing sales year over year and have outcompeted Tesla by almost 5x in total delivery count. This is obviously being led by NIO, Xpeng, BYD, BMW, and Chang'an, which are the other only battery electric automakers in the country. Startups are always going to have a difficult time at the beginning ramping up sales because they don't have the market traction that their competitors have. They don't have the pricing power that their competitors have, meaning they're not able to raise prices as easily as Tesla or BYD. And obviously they have a lack of infrastructure and service availability for their customers. And so when Tesla decided to cut prices to stimulate demand for their inventory, NIO and Xpeng are going to be the first companies to be hit in the short term. This isn't going to affect these businesses over a 2-year time frame unless they end up burning through a significant amount of cash or they reduce their prices so much that they now have negative gross margins, which right now neither of these companies have. And that's why I think this idea that Tesla's price cuts are going to drive out Xpeng and NIO from the market and potentially put them on the cliff of a bankruptcy is really far-fetched, because from a financial standpoint, these companies are not only backed by Chinese regulators and the government, but they also have extremely strong balance sheets in the short term. Unlike a lot of other EV automakers, these companies are actually profitable on a gross margin basis, and their margins have improved throughout 2022, particularly in the case of Xpeng. And even if their operating and profit margins are negative, they have also improved over the past 2 years, which obviously is impressive for a startup. And you should not expect companies that are this young to be automatically profitable from a business standpoint. It is a slow process, and it took Tesla itself over 10 years to approach profitability. And even from a liquidity standpoint, Xpeng and NIO tend to have good availability of cash. As you can see, their current ratio is sitting well above 1.5, which means they have more than enough money to cover their short-term debts that might be due within the next 12 months. And as a result, their valuations have also come down significantly over the past 12 months, driven by the fear of the Chinese stock market and the recession. And that right there, honestly, is where the opportunity lies. As you can see, the Chinese stock market and the tech sector has bottomed from November's lows. We have officially exited the downtrend in the bear market that we saw for the past 24 months. We're now above that 50 and 20-day moving average, and we're seeing a lot of buying pressure and less FUD on Western media, which is driving confidence back into China's sectors. I've been talking about this for the past year, even though as an investor it's been a difficult time to buy Chinese companies. I think right now is still a good opportunity if you understand how China's relationship with their companies function and the role that the country plays in the global economy. And as for how will investors contemplate the competition that's coming from BYD, well, like I said, I don't think this company is a true competitor to NIO or Xpeng. Tesla is really the real competitor, and NIO and Xpeng are now the number 2 and number 3 because they happen to be the only companies selling battery electric only vehicles. That's an extremely important distinction to make because in a certain amount of years, you're going to see regulation on an ESG and emissions standpoint, which is going to completely drive down production and incentives for any vehicle that has an internal combustion engine in it. Over 80% of BYD's deliveries in January were plug-in hybrid vehicles, with only 7,000 of them being actual battery electric vehicles, meaning BYD on average is up there with the deliveries of Xpeng and NIO if you average it out over 2022. Even Tesla itself is seeing how demand for battery electric vehicles is slowing globally, even if plug-in hybrid and new energy vehicles are going up. They recently had to ship out all the vehicles from their Shanghai factory and the Nangang terminal where some of their Tesla Model 3s and Ys typically sit in inventory. They actually ship these out as exports, meaning they're potentially seeing less demand in China for those vehicles, and as a result, they're levitating towards the higher profit margin areas like the US and Europe, even if they just cut prices in those areas. And as we've already seen, Tesla's China-made cars fell to their lowest level of sales in 5 months. This is a sign that production in Chinese factories is faltering and demand for battery electric vehicles has come down because of the recessionary fears in the country. And obviously a company like BYD has more leverage to be able to tackle these recessionary forces because they have plants all across the world. Startups like NIO or Xpeng only have supply chains with single-sourced or dual-source manufacturers within China and Shanghai itself, which leads them to have tighter gross margins and less pricing power in a market that is obviously dominated by Teslas and BYDs. That isn't necessarily a bad thing. It doesn't mean these companies are bad. It just means you expect more volatility in deliveries in the short term, and you should not use that as a metric to let your investment thesis falter. I think this little slump in battery electric vehicle sales in China is not only an opportunity for investors, but also customers. Not only can you buy your vehicles at a cheaper price, but valuations and sentiments for companies like NIO and Xpeng are now at all-time lows, even if the Chinese stock market is rebounding. And as the Chinese market strengthens, there's an opportunity for investors to see cheaper prices when they have so much cash sitting on the sidelines. Autonomous driving, EV infrastructure, and cost reductions are the name of the game in the Chinese market, and they are leading the entire world in this overall adoption. And I think companies that are taking a charge early on, like Xpeng and NIO, are going to still thrive and grow over the next few years, even if there is volatility in the short term. And that is exactly why I continue to be an investor in this sector. But as usual, guys, that is just my take on the situation. So let me know your thoughts down in the comment section below.